studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Let's examine one of the most misunderstood concepts in owner-manager taxation: borrowing money from your corporation. Many shareholders assume that if they take money from the corporation as a loan rather than as salary or dividends, there are no tax consequences. That is not always true. A shareholder loan is different from salary and dividends because, in principle, borrowed money is expected to be repaid. For that reason, a properly structured shareholder loan is not automatically taxable when the money is received. In the example shown on this slide, the corporation has excess funds and advances $100,000 to the shareholder. The shareholder now has access to the money and can use it for personal or investment purposes. At this stage, an important question arises: is this tax-free? The answer depends on whether the transaction is a genuine loan and whether the shareholder complies with the special tax rules that apply to shareholder loans. On the left side of the slide, we see the characteristics of a legitimate loan. There is proper documentation. A loan agreement exists. Repayment is expected. The transaction follows the applicable tax rules. When these conditions are met, the shareholder loan may avoid immediate taxation. However, the situation becomes very different when the proper rules are ignored. On the right side of the slide, we see several warning signs. Perhaps there is no repayment plan. Perhaps interest is not charged when required. Maybe there is little or no documentation. Or perhaps the shareholder loan remains outstanding for too long. These situations attract CRA attention because they suggest that the transaction may not truly be a loan. The CRA will often review the facts to determine whether the shareholder has effectively received a taxable benefit or whether the shareholder loan rules under Section 15 should apply. This is why borrowing from a corporation is never simply a matter of taking money out of the business. The transaction begins with a loan, but what happens afterward is what determines the tax result. The shareholder borrows the money. The funds are used. The shareholder must comply with the applicable repayment and reporting rules. And ultimately, the CRA may review the transaction if questions arise. The key takeaway is that a shareholder loan is not automatically taxable. However, it is also not automatically tax-free. Special tax rules apply, and the ultimate tax result depends on how the loan is structured, documented, managed, and repaid. Understanding those rules is essential because a properly managed shareholder loan can avoid unnecessary tax consequences, while a poorly managed loan can quickly become a significant tax problem. Now that we've seen that borrowing money from a corporation is not automatically taxable, let's look at the situations where that loan can create tax problems. The most important point to understand is that the tax treatment of a shareholder loan depends largely on what happens after the money is borrowed. Receiving the loan is only the beginning of the story. Once the shareholder has borrowed money from the corporation, several different outcomes are possible. The first and most favorable outcome occurs when the loan is repaid on time and in accordance with the applicable tax rules. In this situation, the shareholder follows the repayment terms, the loan is properly managed, and the corporation maintains appropriate documentation. When these conditions are met, the shareholder may avoid the shareholder loan income inclusion rules. This is generally the result accountants are hoping to achieve. However, not all shareholder loans follow this path. A second possibility is that the loan is not repaid within the required period. The money remains outstanding. Repayment deadlines are missed, and the shareholder continues to have access to corporate funds. When this happens, Section 15(2) may come into play. Under these rules, The outstanding loan balance can potentially be included in the shareholder's taxable income. In other words, what began as a loan may eventually be treated as taxable income for tax purposes. A third issue involves interest. Certain shareholder loans require interest to be charged at prescribed rates. If no interest is charged, or if the interest charged is below the required amount, the shareholder may be considered to have received an economic benefit. That benefit can create additional tax consequences beyond the loan itself. This is why tax professionals pay close attention not only to the loan balance, but also to the interest terms attached to the loan. Whenever the CRA reviews a shareholder loan, auditors typically examine several key factors. They look at the outstanding balance. They review repayment dates and repayment history. They examine whether interest was charged and whether the proper rate was used. And they review the supporting documentation, including loan agreements and corporate records. The CRA's objective is to determine whether the shareholder loan is being managed as a genuine commercial loan, or whether it is effectively being used as a method of extracting corporate funds without recognizing taxable income. This is why shareholder loans require ongoing management. Many taxpayers focus only on the moment the money is borrowed. Accountants focus on everything that happens afterward: the repayment schedule, the interest calculations, the documentation, and compliance with the applicable CRA rules. The key takeaway is that borrowing money from a corporation creates ongoing tax obligations. A properly managed loan can often avoid significant tax consequences, but poor management, missed repayments, inadequate documentation, or ignored interest rules can transform what started as a simple loan into taxable income and additional tax liabilities. The tax result is determined not by borrowing the money, but by how the loan is handled after the money has been received. Now let's look at the framework that experienced accountants and tax advisors use whenever a shareholder borrows money from a corporation. Although shareholder loan rules can seem complicated, most tax professionals begin by asking 3 simple questions. The answers to these questions often determine the entire tax outcome. The first question is, was the loan repaid on time? This is usually the most important question. The shareholder loan rules place significant emphasis on repayment. If the loan is repaid within the required period and the repayment is genuine, the shareholder may avoid an income inclusion under the shareholder loan provisions. This is why accountants carefully monitor repayment dates and maintain schedules showing when loans were created and when they must be repaid. The second question is, was interest charged? Many shareholders are surprised to learn that interest can be an important tax issue. In certain situations, the Income Tax Act expects interest to be charged at prescribed rates. If the corporation provides funds without charging the required interest, the shareholder may be receiving an economic benefit. That benefit can create additional tax consequences separate from the loan itself. As a result, tax advisors often review not only the loan balance, but also the interest terms attached to the loan. The third question is, was the loan properly documented? Documentation is often overlooked, but it plays a critical role in supporting the tax treatment of the loan. A properly documented loan should generally include a loan agreement, repayment terms, supporting records, and evidence that the parties intended the transaction to be a genuine loan. Good documentation helps demonstrate that the arrangement follows commercial principles and is not simply an informal withdrawal of corporate funds. When accountants review shareholder loans, they typically work through these 3 questions in sequence. Was the loan repaid on time? Was interest charged when required? And was the transaction properly documented? The answers help determine whether the loan complies with the tax rules and whether additional tax consequences may arise. This is why good shareholder loan management focuses on more than just receiving money from the corporation. Proper documentation should be maintained. Interest rules should be reviewed. Repayment deadlines should be tracked carefully. When these steps are followed, CRA risk is significantly reduced. By contrast, poor loan management often creates problems. Missing documentation, ignored interest requirements, late repayments, and poorly maintained records all increase the likelihood of CRA scrutiny and potential reassessments. The key takeaway is that borrowing money from a corporation is not judged solely by the amount borrowed. The tax consequences are determined by repayment, interest, and documentation. These three factors form the foundation of shareholder loan planning and are the first things experienced tax advisors examine whenever they review a shareholder loan arrangement. If those three areas are managed properly, many shareholder loan issues can be avoided before they ever become a CRA problem.